Hey, what's up everyone? My name is Patrick. Hope you guys have an awesome day. So in my last video, I talked a little bit about the different brokers in the UK and some of their associated fees you may face when dealing with their shares or funds. I also talked a little bit about the different types of ISAs available in the UK and why it's important to maximize the £20,000 a year contribution if you can, due to the very useful tax benefits you receive. So if you haven't seen that video, please go check it out. Just as a disclaimer, I'm not a financial advisor or qualified. These are just my personal opinions on things I've learned over the years, and I hope to share with you guys in a fun way and hopefully help you achieve your financial freedom dreams. As with any investment, it's important to do your own due diligence and research so you feel comfortable with your choice. Which leads on to what I'll be talking about today, covering why it's important to approach every investment with caution, getting comfortable with the idea, and the final push, which is getting that conviction and belief into your investment to weather any turbulent market times. So the first thing I'd like to cover is just about being cautious when it comes to investing, especially in the age of tech and online media. You need to be able to block out the noise and focus on what's important. It is really easy also to fall into the mindset of wanting to get rich quick, but the reality is it takes a long time to grow your wealth. And from my personal experience, times I've lost the most money was when I threw caution to the wind and went with a YOLO attitude, following some random person's advice on the internet. It almost never works. For example, say you were looking to invest in this lovely house. On the surface, it might look amazing, but wouldn't you want to check that the house is in good shape on the inside, that doesn't have any hidden problems, and that hopefully in the future you could sell it for a good profit, getting this guy's approval? Just because someone said it's a good investment, it doesn't always mean it is. This is no different to how you should approach your investment into the stock market. There is nothing wrong with getting an idea from someone, but never follow those ideas blindly. Do your own research just like you would on a house. Check that the company or fund has a bright future ahead of it with plenty of room to grow and generate profits, and that has historically performed well and delivered consistent returns. A cautious approach can help you from making poor investment choices. Secondly, it's important to get comfortable with the idea of investing. Build on your initial research. Ideally, you would like as much information as possible before investing, like you would a house. How many parks there are there nearby? Is the area relatively safe? Do you see yourself living in this house? And just like a house, an investment is a commitment. You need to be asking these kind of questions. What is the competition? Is this really the best place for me to invest my hard-earned money? The more answers they can answer yes to questions like these, and the more research you do, the more comfortable you get with the idea of investing in the company or fund. You want to be able to sleep at night with relative ease, not worrying if you made the right long-term decision based on changes in the price day to day, and this will help you trust your judgment in the long term. The historical data is always there to prove it. A little test that you could do is hypothetically invest a sum of money 1, 5, 10 years ago, whatever your time frame may be. How does the investment look like now? If it's positive, it should help you put your mind at ease that the company is performing well. If your investment has made it for the first two stages, that is great. You've most likely got a good investment on your hands. Whilst returns are never guaranteed, doing the research means you have done your part in increasing the chances of making a good investment. I can almost guarantee you there is not a single investor who hasn't made a bad investment choice, and as a potential investment you have to accept that risk, which is why people choose to diversify their investment. Time will decide the outcome of your investment, but you'll feel a lot better having read up on the company, fund, or whatever you decide to invest in. This is why I've added a little extra section called conviction. Having a conviction investment has personally helped me become an investor, and I hope it can for you too. This is because it completely stops emotions and other people influencing you. This can be applied to any type of investment, but is more geared for individual stocks. Here we have an example of person A and person B. Say they decided to both invest in Apple 5 years ago. They did research, they both liked the company and their products, and saw that the company has potential to grow even bigger, and decided to pull the trigger and buy one share. You can see from the price, the investment goes down initially, and person A might start doubting their choice and decides this was just the wrong company to invest in and sells their shares. They knew the risk going in and just chalk it up to bad luck. Person B invested at the same time with the same information that was publicly available. He comes back and checks the price 3 years later and it's increased quite nicely. Person B is thinking, gee, I'm glad I did all that work researching the company, otherwise I might have sold it when the market went against me. Person B had conviction, and that was the difference. They had confidence and conviction that regardless of any short-term changes in value, which might have been caused due to unrelated news to the company, like an election or bad news temporarily, the longer term potential was there. Whereas person A might have heard any bad news and let it influence their investment decision. Even further in time, 5 years on, you can see that person B has made the right investment choice and has returned his money almost 5 times over. That one share for person A selling shortly after they purchased the price almost caused them a 20% decrease in their investment, whereas the person holding on for 3 years, due to their conviction, had a profit of 46%. And it's hard to pinpoint exactly what helps getting this level of conviction. For people, it varies. Unless something drastically changes fundamentally with the company, having conviction will help you weather any temporary turbulence and help you get those longer term profits which you're looking for. Personally, for me, it's avoiding bad short-term news, watching interviews with the CEO, following developments and understanding what the company's longer term vision is. Have they delivered on their prior promises and commitments? These kind of questions and additional research can help you build that conviction and stomach when the market may be down. However, conviction can also be a dangerous thing in the wrong company, as there can be things that have been overlooked on the surface or behind the scenes might not be available to the public knowledge. So there's always a level of risk. I hope you guys have liked this video, and if you have done, please like and subscribe to the channel, and I hope you guys have learned something from this video. If you have any questions, please drop them in the comments below and I'll happily answer them. Thank you all for watching, and I'll see you guys in the next one.